How's it going, YouTube? Limelight Capital here, back for another video. So I'm going to be doing two shorter posts here from the Superstonk Reddit page. Just a reminder, guys, leave a like on the video, leave your thoughts on the post in the comments below. Please leave a subscribe on the video. I am going to be doing giveaways coming up pretty soon. And yeah, any support is much appreciated. I'm just a fellow ape like you guys, trying to get this information out to people. And, for whoever wants to listen, I hope this helps somebody. Let's just jump right into it, guys. So I have two posts here. One is titled "Why Market Orders and Stop Losses Are Bad," explained in ape-friendly terms. And the second one is "The Imminent Liquidity Crisis and Reverse Repos Usage, Smooth Brain Edition." So these are two really light, really light posts, but, chock full of information. And let's just jump right into them, guys. So let's start with "Why Market Orders and Stop Losses Are Bad," explained in ape-friendly terms. This is posted by Fresh Tartar Sauce. Again, on the Superstonk Reddit page, which is the official, and maybe not the official. I hate using the term official, but it's the place to be for GameStop stock information right now. So let's start off here. I think most of us know not to set stop loss or market sell orders, but for those of us who don't really know and aren't sure why, this is for you. I'm going to explain why these orders are objectively bad, and that anyone who suggests you use them is either uninformed or a shill. Before we go into detail, it is important to know what the bid-ask spread is. If you already are familiar, feel free to skip to the next section. Order types explained. What is the bid-ask spread? In any market, you have buyers and sellers who are willing to make exchanges at different price points. The buyers will place a bid for an item, which is the price they are willing to pay to own it. Sellers place an ask, which is the price someone is willing to sell for it. When a buyer and a seller has the same price, an exchange is made. The spread is just the difference between the bid and the ask. I know it sounds super simple. That's because it is. In the stock market, there are millions of buyers and sellers, so the spread is often very small, often within a penny. When there is an abundance of people trading a security, that is a sign of a liquid asset. Investopedia defines liquidity as the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. Liquid assets move slower and are less volatile than illiquid assets. In the case of GameStop, it is already illiquid and is going to be even more so after the squeeze. This means that as the squeeze happens, there will be a very wide spread. So what? Well, let's get into the different types of orders and what they would mean practically. Order types explained. I'm not going to get into every order type, but I will explain the basic ones that are applicable here. To make things easier, I'm going to use the bid-ask spread of 50K / 10 million as an example. Let's start with buy orders. 1. Limit buy. What this order does is place a bid into the order book. Let's say you're willing to pay 100K for a share. You place this order, and the spread will now be 100K / 10 and you will have to wait for a seller to be willing to sell to you for 100K, or wait for the dumbass to place a market sell. Market buy, this order takes the smallest ask and you buy at that price. If the smallest ask is 10 that's what you pay. When hedgies get liquidated, market orders get placed to close their position. This is what will cause the squeeze to happen in the first place. If you want to buy shares during the squeeze for whatever reason, do not place a market buy. Chances are, if you're already reading this, you're not going to FOMO in because you already have shares and sell orders are more applicable. Limit sell. This order places an ask into the order book. Let's say you want to undercut the smallest ask. You might place a limit sell order for 9.9 million, so yours is now the best price. Any market orders will now trigger your share to be sold at your limit price. Market sell. This order will find the highest bid and fill your order out there. In our example, your order will fill at 50K, 9.95 million less than the lowest ask. This is obviously bad and requires no further explanation. Number 3, stop loss. This order will trigger a market sell once the price is less than your stop loss value. Example, let's say the price is 69 million and you set your stop loss at 10 million, your floor. What will happen is the price will cross 10 million on the downside and place a market sell order. Let's say the highest bid is 12,000. Congrats, you just sold your shares for 12,000. So what the F should I do? Don't place market sell orders if you want to set the price. You held this long primarily to set your price. Why wait all this time to sell to the highest bidder? Make them come to you, that's why it's a squeeze. 2. Don't set stop loss orders at your floor if you want the biggest price. You will not get filled at the value you set. The trigger point only serves to trigger a market sell. 3. Don't buy with market orders if you choose to buy. If you do, you're going to have a bad time. 4. Do place limit sell orders whenever you're comfortable selling. This will ensure you get the price you want. Seriously, when the squeeze happens, the spread is going to be very wide. You don't want to be eating that spread when you sell. Anyone who suggests you do is an idiot. Remember, we are retarded, but not stupid. So yeah, guys, I just wanted to get this information out. I'm sure most people know this. This is kind of, basic information within the GameStop and especially Reddit space. But on the off chance that someone doesn't know this, I did want to get this out there. It is a simple yet important message, and the message is, especially for a situation like this with GameStop, it's very, very important. Once this squeeze starts, the mother of all short squeezes, the MOASS, starts, it is very important not just if you're going to be selling shares, it's very important to not do a market sell because, you could get lowballed and obviously hedge funds will be trying to buy shares back as cheap as they can. And if you do a market order, it's just going to be, you're going to be kind of shit out of luck. So, next one here, guys, is titled The Imminent Liquidity Crisis and Reverse Repos Usage, Smooth Brain Edition. And this is by username Plant69. Intro. Many of us apes have been hearing about reverse repos and the liquidity crisis as of late, but some may not understand what that means or looks like, and I'm going to explain it and show the relevant data as simply and clearly as possible so that even a brain as smooth as a watermelon could form a wrinkle or two. Technical explanations, suit jargon are simplified by the emojis. Reverse repo usage and the imminent liquidity crisis. The daily aggregate of reverse repo transactions is signaling a major and imminent liquidity crisis. It is only a matter of time before the Fed has to taper the money supply or else risk long-term substantial inflation. So there's a little chart here that just shows the history of reverse repo. And, for anyone that's not watching the screen or needs an explanation, basically when it comes to reverse repo, we hit levels currently now in 2021 in May that were higher than last year, even during, when the start of COVID. That is very alarming to a lot of people, including myself. So I like the lines and colors, but what does this graph mean? Overnight reverse repurchase agreements are short-term, often overnight timeline purchase of securities with the agreement to sell them back, usually at a higher price. The Fed is buying back corporate and U.S. Treasury bonds in accordance with quantitative easing to reduce the supply of money. Quantitative easing, what the Fed likes to call money printing. The increase in reverse repos is signaling a corresponding increase in quantitative easing. Tapering, starting to turn off the money printer. What is the liquidity crisis? Liquidity is determined by how quickly a business can convert its assets to cash. A lack of liquidity can occur when a market has very few buyers or sellers or both. One of the biggest sources of liquidity in the U.S. markets comes from repos and reverse repo agreements. The repo market exists for short-term transactions. Repo, the buyer purchases some securities for a short-term period. Reverse repo, the buyer agrees to sell those securities back at a slightly higher price. A liquidity crisis can happen when all of the banks decide to lend all their bananas out because they make a fortune collecting fees. What happens when the market goes red? No one can pay each other back because banks and hedge funds over-leveraged themselves to the tits and rehypothecated all of their bananas in a synthetic banana ice cream. And they lent all that out too. When they run out of bananas, they run out of liquidity. The music stops. If institutions lack the liquidity to perform their daily operations, they must sell off assets and securities to survive to avoid a margin call. If enough institutions lack liquidity all at once, this can trigger market-wide sell-offs. So there's the user types, what does a liquidity crisis look like? And it has a bunch of dates here. And, it goes basically from the May 5th and skips a couple days in between all the way up to now, May 20th. And, all the reverse repo from May 5th to now adds up to $351 billion. And he says, holy shit, that's a lot of bananas. Today, we surpassed the highest amount of reverse repo purchases on the March 2020 crash at $285 billion by over $65 billion. Is this sustainable? F no. It's either tapering, printer doesn't print anymore, or the USD will eventually become, overinflated. So Zoltan Poznar, managing director at Credit Suisse, says the reverse repo purchase cap is a key piece of our warehousing puzzle. The $1 trillion of reserves we're trying to find a warehouse for are currently warehoused by the Treasury. U.S. banks can't add another $1 trillion to their warehouses, and money funds can't warehouse $1 trillion unless the Fed decides to uncap the reverse repo policy. Unless the reverse repo purchase facility gets uncapped, bill and repo rates can trade negative, and money funds may turn away inflows as they won't invest at negative rates. What does that mean? The Fed has trapped themselves and banks in a corner after producing too much cash through quantitative easing. High reverse repo purchase usage mid-quarter spikes at the end of the quarter are typical, signal that banks simply don't have the balance sheets to accept the excess reserves. They are forced to park the reserves right back with the Fed using the overnight reverse repo purchase. This can have a disastrous consequence if quantitative easing or printing continues at its current trajectory. Even simpler, repo rates go negative because collateral is in high borrowing demand. The Fed is buying back the quantitative easing program, decreasing supply. There is a banana shortage caused by printing. In order to balance the effects of printing, new bananas end up recycled right back into the overnight reverse repos, and as the toxic cycle continues, more bananas are produced in the reverse repo purchases, bought and paid for by printing. See the problem? Currently, the liquidity in the U.S. stock market is entirely artificial because the Fed won't stop printing, because the slightest bit of federal tapering could shut down the entire game. It's either no more bananas for anyone, or so many bananas that the value of bananas becomes near worthless. No bananas, no liquidity. Okay, I learned a few new words, but what does this have to do with our favorite stonk, Gamestop? No liquidity means that major institutions will have to sell off securities and crypto to increase their capital supply. If they can't increase their capital supply to meet a certain threshold, margin will ring and ask for a deposit. If Citadel and hedge funds can't make a deposit, aka prove liquidity to be able to cover their positions, the DTCC will forcibly close all their positions and GameStop will be catapulted into Andromeda and beyond. So yeah, my take on this second one and why I wanted to put this in the video is that, this is very alarming, especially looking at this chart. Knowing that the banks and the hedge funds and the 1% are very over leveraged, just knowing that, it does seem like a market crash is inevitable and inflation is happening, hyperinflation could be happening, and particularly with GameStop, we are fighting certain hedge funds, in particular, predatory, naked, short-selling hedge funds like Citadel. And, if they run out of money, they're screwed. And, like it says at the end, if Citadel and hedge funds can't make a deposit, if they can't cover their margin calls, then the DTCC will be forced to close all their positions in games and buy out, their positions and basically buy, countless GameStop shares, and the price is going to get, skyrocketed into space. So, I hope this information was helpful to someone. Again, I'm just a fellow ape trying to get this information out to someone that I can help. The overall message of this video is that, market orders are terrible, especially during the squeeze. Please use a limit order. And, the second one is kind of signaling that, a market crash may be imminent. It's possible, unless the only choice is there's going to be a crash and or there's going to be major inflation and the Fed is just going to keep printing money. So, yeah, guys, again, please leave your thoughts on this down in the comments. Leave a like on the video. It would be greatly appreciated. Definitely subscribe to the channel. Going to be having more and more content coming out, crypto-related content and GameStop-related content. I do a little bit of both. I'm in all finance here. I'm not picky. Anything that makes me money, I like it. So, yeah, guys, definitely please leave your thoughts. I do have giveaways coming up. The details on that are in the description below. And other than that, I hope you guys enjoyed the video and enjoy the rest of your day. Thanks. I'll catch you in the next one.